Welcome, everyone. Today, we've got a really fascinating explainer lined up for you. We're going to completely demystify management controls. If you've ever found yourself wondering how these massive, hyper-complex organizations actually keep from descending into total chaos, well, you are definitely in the right place. We're going to take these concepts straight from boardroom theory right down to the grease on the factory floor, just to see exactly how the whole shebang works in reality. Okay, let's dive into this. So, here's our roadmap for today. First, defining the rules. Then, roles and responsibilities. Third, the control toolkit. Fourth, practice, production and finance. Fifth, practice, protecting inventory. And finally, some final takeaways.
Right. Section 1. Defining the rules. What actually are these controls?
At their core, management controls are simply the mechanisms put in place to guide, monitor, and evaluate an organization's activities. Think of a massive cruise ship, right? Management controls, they're the navigation systems. They're the engine governors. In a corporate office, it's like utilizing real-time budgeting software that actively prevents a manager from signing a purchase order if their department is, say, already over budget for the quarter. It literally stops the error before it even happens, keeping the whole organizational ship precisely on course.
Moving on to Section 2, roles and responsibilities. Who actually builds this system?
Well, every single person has a duty in this ecosystem, and they're working in a strict hierarchy. The CEO establishes what we call the tone at the top. Now, if a CEO openly bends expense report rules, lower-level employees are going to immediately assume that taking shortcuts is just the company culture, right? And that causes the entire control environment to basically collapse. Then you have the board of directors. They provide objective judgment, selecting senior management and utilizing specialized committees to oversee things like risk and audits. And further down the hierarchy, we have the rest of the personnel. Listen, everyone is a watchdog. If a factory line worker sees a security gate left unlocked, it is their explicit duty to report it upward.
Now let's look at a really critical distinction here. Management versus internal auditors. Management is ultimately responsible for the design, the function, and the execution of the internal control system. The internal audit function, however, merely evaluates that system through systematic reviews. Think of management as the chef who designs the recipe and cooks the meal. The internal auditor, they're the health inspector. So the crucial point is, to remain completely objective, the health inspector absolutely cannot be the one chopping the vegetables. They must remain completely independent to effectively evaluate if management's kitchen is actually safe.
Section 3. The control toolkit. Let's look at the actual blueprints for order.
So management is in charge of designing the controls, but what exactly are they building with? First up, organization. You intentionally structure roles so no single person controls all phases of a transaction. Then you have policies guiding action. And interestingly enough, if a company's culture is intensely strong, you actually need fewer formal written policies. Next, procedures. These are coordinated methods designed so one employee's work is automatically reviewed by another. And finally, personnel. You hire, train, and supervise. A really brilliant example of a personnel control is rotating buyer assignments. Look, if one purchasing agent buys all the steel from the same vendor for 5 years, they might develop a kind of inappropriately cozy relationship, right? Maybe accepting kickbacks or ignoring cheaper competitors. But by automatically rotating buyers every single year, you disrupt any chance of favoritism and you keep that supply chain totally honest.
All right, let's talk about the financial scorekeepers. Accounting tracks your controllable costs based on specific lines of responsibility. Budgeting sets the standard for resources and demands immediate feedback when variances pop up. It's effectively a form of discipline. And regarding reporting, here is a golden rule straight from the boardroom. A timely report based partly on estimates is often way more useful to management than a perfectly precise but delayed report. I mean, if a factory is bleeding cash on a faulty assembly line, management needs a rough estimate on Friday afternoon so they can shut the line down for the weekend. A perfectly precise, down-to-the-penny report delivered on Wednesday, that means you've just wasted 4 entire days of cash.
Section 4. Practice, production, and finance. Let's see these controls in practice.
Okay, we are officially moving out of the rulebook and into the real world. We're going to apply a 5 whys approach to see these controls in active practice, starting with production. One primary control is requiring detailed material specifications for all purchases. Now, why? Well, imagine a car manufacturer. If the purchasing department just orders aluminum instead of highly specific aerospace-grade aluminum, the final car doors might literally dent under normal wind pressure on the highway. Strict specs stop that kind of disaster before the wrong metal even enters the factory.
Another crucial production control is the relentless comparison of actual production with management forecasts.
Again, why is this necessary? Because comparing actual to budgeted costs is a literal financial tripwire. If you budgeted for, say, 10 gallons of paint per car, but actual show you're consistently using 15, that cost variance triggers an immediate alarm. It tells management that either the painting machines are calibrated wrong or employees are spilling paint, and it tells them this long before the quarter ends in a massive unexplained loss.
Shifting gears to finance, specifically debt and equity instruments. The primary control here is the strict segregation of custody of assets and the recording of those transactions. Think about it. If the same person who holds the keys to the vault also writes the accounting ledger, they have ultimate power. They could literally take physical company assets, like bearer bonds, walk down to a local bank, use them as collateral to secure a personal loan, and then just erase the bonds from the company ledger to hide their tracks. And this brilliantly illustrates why you absolutely must separate the ledger from the vault. Let's stick with corporate capitalization for just a second. I want you to really think about this question. Why do we mandate that major funding proposals be reviewed strictly by the board of directors rather than just senior management?
Well, the answer all comes down to authorization controls. Taking on a massive $50 million loan or issuing millions in new stock, that fundamentally alters the risk profile of the entire company. A decision that could literally bankrupt the entity cannot be made by one rogue executive. It has to be debated and approved at the absolute highest level, by the board, to protect the shareholders and execute management's ultimate wishes.
Section 5. Practice. Protecting inventory. Time to look at physical safeguards.
Now, assets aren't just numbers on a page, right? They're physical tools, equipment, materials. To physically protect these assets from unauthorized access, we don't just put up a sign saying, "Safeguard assets," we install key cards. Why? So that if a $5,000 power tool goes missing at 2 a.m., the superintendent has a digital, undeniable timestamp of exactly whose card swiped that door. It creates absolute accountability and, honestly, immense psychological deterrence.
This creates a highly specific operational flow for inventory custody. Step 1. Receive. When items arrive, the receiving function verifies the delivery against the shipper's log so items aren't immediately lost or stolen right off the loading dock. Step 2, and this is critical, secure. Custody belongs strictly to storeroom staff. You never, ever give free access to the production line supervisors. If the person using the materials also controls the inventory vault, it's like letting the fox guard the hen house. They could easily cover up gross waste or theft. Step 3, requisition. When tools are needed, special requisition forms are required to ensure the items requested actually match the process being performed.
So let's pose another why question to explore the balance of managing supply levels. Why use a perpetual inventory system, and why implement electronic data interchange, or EDI, with your suppliers?
Because it's a massive financial tightrope. You use EDI to communicate instantly with suppliers and automatically order things like screws, so the production line never suffers a catastrophic shutdown. But simultaneously, you track everything, perpetually, to ensure you aren't sitting on a mountain of excess inventory. Because a warehouse full of unused microchips, that costs you an absolute fortune in heating, security, and tied-up capital that could have been invested elsewhere to actually grow the business. But here's the kicker. Even with brilliant digital systems, you still have to verify reality. Periodically, independent auditors must literally walk the warehouse floor with clipboards, physically opening boxes and counting items to reconcile against the software. Because without these physical test counts, millions of dollars of ghost inventory could exist only on a computer screen, completely hiding the fact that goods were damaged or stolen months ago. We've looked at production and inventory. But let's use our final why to probe perhaps the most common financial control mechanism of all. Why must bank reconciliations be performed by an independent third party? Simply put, independence is the only way to ensure the financial scorekeeper is telling the exact truth. An independent party has zero incentive to hide mistakes. If an internal accountant made an error, or worse, was actively skimming cash by altering deposit slips, they would instantly manipulate the bank reconciliation to hide their tracks. An independent third party catches those hidden charges, lost deposits, and phantom checks because they have absolutely zero skin in the game. We're going to wrap up our explainer today with this direct quote from the source material. Everyone in the entity must be involved in internal control and is expected to perform his or her appropriate control activities. Listen, management controls are not just for the auditors. They are the literal fabric that holds an organization together. So, my final provocative thought for you to take away is this.
Are you an active participant in your organization's control environment, meticulously executing your part of the design, or are you just waiting for someone else to catch the errors? Thank you so much for joining me today, and keep asking the right questions.